Welcome to Advisor Confidential, the podcast series that dives deep into the evolving world of registered investment advisors. Whether you're an established RIA, exploring the independent advisory space, or just curious about the future of fiduciary finance, this is your go-to source. We'll bring you expert insights, candid conversations, and real-world stories from the front lines of wealth management.
What is actual investing? We believe that it's our real-world task to deliver thoughtful capital deployment. It's not about speculating over the short term, it's about understanding the long-term opportunities for companies through technological progress or new business models. So we seek out those exploring big, new ideas that will change the world. Then we back them to give those ideas time to flourish. Baillie Gifford, Actual Investors. Find out more at baileygifford.com.
Good afternoon and welcome to Advisor Confidential, the podcast series. I'm Evan Simonoff, Editor-in-Chief at Financial Advisor Magazine. Today's episode, Long Duration Equity Investing, is brought to you by Baillie Gifford. I want to welcome our special guest, Jack Ablin. He's the founding partner and chief investment strategist from Cresset Capital. And today we'll explore how to turn out some of the short-term noise and identify long-term trends on the investment horizon. So without further ado, let's dive into the questions. Jack, let's talk a bit about the concept of long-duration equity investing. I'm thinking primarily about VC and private equity, but also really long-term holding periods for publicly held equities. How do you think about it? Much of the current interest is being driven by the decline in the number of public companies, and how relevant is really the so-called democratization of investing that we hear about all the time, and how much of that is real and how much of that is talk?
Well, great. First of all, Evan, thank you for the invitation, and it's a pleasure for me to be on the podcast. So I think that long-term investing is critical, just because that's as we know, the magic of compounding really works. It also allows long-term investors to really focus on valuation. Markets can be expensive for a couple of years at a time, but over long periods of time, cheap markets outperform expensive markets. You can be wrong, for a couple of years with using valuation, but over long periods of time, valuation is a critical metric in investing.
What do you think started this private equity boom? I think sort of companies like KKR and Blackstone started in the 80s, and they were not really venture capital firms. The venture capital movement sort of petered out in the 80s and then exploded in the 90s, and it's been a little more cyclical. But do you think there was something that really sort of jump-started it, and the desire not to be a public company that's really declined in the last 25 years? Was it Sarbanes-Oxley or?
Yeah, I think it's a couple of things, Evan. I think Sarbanes-Oxley certainly is a contributor. I mean, the fact is that anyone who signs those financial statements is literally on the legal hook for their validity. So I think that's part of it. I think also is the short-term nature of public investing, where investors want results every quarter, and private equity is really, getting back to your original question, is really more long-term focused. So I think that's part of it. In terms of the Blackstones and the KKR, they were, primarily serving the institutional customer. These were, customers like foundations, endowments that had, similarly, longer term time horizons. They had very high tolerance to illiquidity, and they recognized that the private markets have historically traded at a substantial discount to public markets, because there isn't that discovery that's going on every day in the private market sector.
Okay. When we think of investors in private equity and venture capital, I think you just mentioned endowments, pensions, sovereign wealth funds, people who have a very long-term horizon. How should advisors view it in the context of their clients who are typically individuals and families who are maybe investing for multiple generations?
Yeah. So what we do, Evan, at Cresset is as we construct a portfolio, we really, rather than break things up into asset classes, stocks, bonds, commodities, currency, things like that, or alternatives, we really look at investments on a different time horizons, and try to structure a portfolio that delivers cash and return of cash on a different schedule. So we have four primary strategies, and I would say venture capital and a lot of illiquid investments are concentrated in our 15-year and beyond category. We call aspirational, and these are generally higher risk, higher return, illiquid opportunities that we expect will play out over multiple market cycles.
It's no secret that private equity has discovered the RIA space, and RIAs typically possess many of the characteristics that long-term investors, even sovereign wealth funds, are seeking, because they are looking at running a firm over the life cycle of the client, or in many cases, multiple life cycles of a family. Do you agree with that perspective? And I guess, is there a certain wealth level that you move from the lifespan of the individual client into, the aspirational, what do you want for your family? What do you maybe want to leave to charity, or what sort of legacy do you want to leave? Because you're not spending all your money. I know varies from individual, but is that typically if 5 or 10 million? I suspect you're seeing a lot more clients.
Yeah. So let's think. Yeah, let's think about it this way. First of all, obviously, not all RIAs can position themselves as quote unquote sovereign wealth funds or have the luxury of that time horizon. A lot depends on the clients they serve. We generally work with ultra high net worth families and family offices, many of whom are CEO founders of businesses. So they're intimately familiar with private investing, either their own company or a portfolio of real estate. But getting back to your question about size, generally, if you're going to invest in private markets, you want to perhaps at the very least have, let's say, half in private equity and half in real estate. So let's say you decide, and you need to have, let's say at the very minimum, 3 vintage years for each. So that, and assume that each minimum investment now is $250,000. So that would assume that you would have to put $750,000 over 3 years in private equity and $750,000 in 3 years over over real estate. And so that's $1.5 million, and assume that that's 10%, or even if it's 20% of your allocation, you're looking at you're looking at a $7.5 million portfolio to a $15 million portfolio. So it is a sizable lift in order to get reasonable diversification and adequate coverage in private markets. So this notion of democratization, to me, is somewhat anathema to what private investing is all about. It does require a long-term time horizon. So taking seemingly illiquid assets and putting them into a quarterly liquidity interval fund, can lead to mismatches and perhaps some disappointment.
Yeah, our next question surrounds liquidity. And, does the liquidity premium, with all this money going into private assets, does the liquidity premium still exist? And it probably exists more in certain asset classes than others. Where do you see some of the big advantages, and where are there fewer advantages? Which markets?
I would say the best illiquidity premiums available in the marketplace today tend to be more on the credit side than the equity side. And that's largely because of just, the path of interest rates over the last few years. And so, for example, take private credit, look at the premium that floating rate private credit can offer over floating rate liquid securities. You're looking at premiums in excess of 6%. And so that's a very sizable incremental advantage. Same thing on the debt side in real estate, that a lot of the real estate debt currently, or at least up till recently, I haven't looked very recently, but offers yields in excess of cap rates, of the kind of the equity returns on the underlying asset. Unless you expect a huge run up in its value over time, the debt side is offering a little more illiquidity premium than equity. I think some of it has to do with the private markets are very slow to adjust. Sellers who don't want to sell at a loss, and so they're keeping their portfolio marked. But the fact that we saw an across the board rate hike in 2022 forced, for example, public real estate values down nearly 20%, a little bit more than 20%, and private real estate values barely budged. So I think owners are slowly recognizing that. Interest rates are also coming back down a little bit. But right now, as I say, I think that the best illiquidity premiums are available on the credit side of the private market equation.
Okay. Have you heard of, I have heard, and it's only from one or two family offices, so it's not a huge sample, but I have heard some frustration with private equity funds that tend to, people were told that they would be liquidating their investments in 5 to 7 years, and suddenly said, well, we're not going to sell it. We're going to sell part of it to a new investor and put that into a new fund. And maybe you can cash out a little, but you're going to be stuck. And if you want to put more in, we're happy to take it. Have you heard a little bit that they're not getting the liquidity events?
Yeah, I have heard that. Part of it is this, the valuation, that sponsors don't want to sell holdings at a loss in the face of substantial a rate rise, and so distributions have kind of trailed expectations, while commitments and drawdowns have increased, and so that's put some private market holders in a bit of a liquidity bind, expecting that they were going to get distribution sooner than they have. Sponsors have come back and said, okay, we're going to take some of the residual holdings that we have and move into a continuation fund. That's somewhat of a quote unquote exit. Private equity secondary transactions have increased. And so it's a way to create artificial liquidity in the market. But I do think now with IPO activity up as much as it is, and the valuation in the public markets as high as it is, I do think now we could see an opportunity for exits back into the public markets.
And possibly some growth, at least in the number of public companies. If markets stay at this level, you would think that people who would thought twice about doing an IPO would now be saying maybe it's time to rethink that. And maybe some of the downside of being a public company, quarterly SEC reporting and whatnot, is there, it's worth accepting some of that if you can get a high value public valuation for your company.
That's it. I mean, you've got the S&P trading at, call it 25 times forward. You got Mag 7 trading at over 30 times forward, where historical valuation medians are around 17 times. And so, yeah, I think that when equity markets get, this STEMI, I think it does create an opportunity to bring private market companies into the public markets sphere.
Yeah. And let's talk for a second, you alluded to a few minutes ago, about the secondary markets for private companies. I mean, I remember you heard about before the financial crisis, people were before it ever went public, there was a market for, obviously for Facebook, because so many employees had shares. They had to report quarterly. I think Uber was the same thing. I know someone who worked in the secondary markets who's said, I think this was 10 years ago, he got a call from a guy, can you get me $50 million? It was in a big institution of Uber. And it's, I guess there are two perspectives about the secondary markets. One is that you're likely to get something that's done so well, like an Uber or a Facebook, and the company's got, for some reason, they want to hold off going public for a year or two, that it's become a very big chunk of some university or pension or individuals. In the case of individuals, if you're an executive at a company like that, that's probably 80-90% of your portfolio, and they're very desperate for diversification. Or the other flip side is that people are, how would I say, if they're not looking to sell their dogs, they're looking to sell some things that haven't been the greatest investments and move on to other investments. Does that characterize that market in your view?
It, to some degree, yes, Evan, it does. I think there's another category, and that's just raising capital of fast-growing companies. So, for example, OpenAI has not been shy about raising equity. They're doing it in the private markets. They're doing it at seemingly discount to public valuations. And so this is a way for these fast-growing unicorns to raise capital. And part of the reason why companies have probably stayed private is because they can raise capital as easily as they can. But I think that certainly every other seller that you've described is part of that equation as well.
Uh-huh. I mean, the one thing about the secondary market that I think is advantageous as opposed to going into a blind fund is that you can actually sit there and the company will, if you're going to buy $20 million of, they'll give you their financial records and they have a track record. And when they expect to be profitable is likely to be, a lot more, they're likely to have a much better idea than when they were first starting up in something out of the proverbial garage.
Absolutely. I think that understanding, either direct investing versus blind pools, I think certainly is to investors' advantage in many respects. I think one of the attributes that sets Cresset apart is that we do have the wherewithal to diligence an individual company. So we don't necessarily have to rely on third-party managers finding the right opportunities and going into blind pools. We'll do that too if we like the manager, but I will say if a deal comes along like an OpenAI or Palantir or something like that, we have the wherewithal to be able to value the company.
Yeah, and I guess question, we are now seeing these investments. It really hasn't happened yet, but we're likely to see it in the next few years. These investments, or some of them, become available in 401k plans and other vehicles. I've heard people that some of the big RIAs that half their businesses in the 401k market, they're not necessarily all that eager to be the first one in the water. But what's your take on this?
Yeah, I think that using private markets, private investments in 401ks, arguably does make sense because the time horizon does match up, particularly for young investors that have multi-decade time horizon. On the other hand, what runs counter to private investment is the cost of chopping up these investments and tracking them in such small bite sizes. To get adequate diversification, you end up with a lot of intermediate steps, and each intermediate steps has a fee. So I would want to make sure that anyone looking at putting private investments in their 401k retirement account understands and is comfortable with the fees involved. Certainly very easy to buy an index fund and hold it for a long time and do it at a very low cost. I don't expect that private investments will be as cost effective.
No, I mean, you just think about 20, 30 years ago. I remember mutual funds who were looking at the 401k market were saying having to process all these $50, $80 checks every 2 weeks is very labor and technology intensive. They made it very they've used technology to get the labor out of it now, and so companies like Fidelity and Vanguard have that's one reason they become tech powerhouses, because they had to. And it but to do this with private investments just seems where they don't price daily, and how do you do it? It's kind of intricate. Okay, a final question would be, do you find similar opportunities or situations where you will hold a public company for a very long time? That is often if you look at, I'm sure at wealthy clients, in a lot of cases, they may have had a business or something, a private business, but in investing, some of them did it in index funds, or a really good actively managed fund. But a lot of them, certainly, and this is probably more true 10, 20 years ago, was grandpa bought the Merc or whatever it was, in the Midwest, ITW, or you can go to almost any region and, find, thinking, out in California, someone was into a drug company. And often that becomes a problem with the client, getting them to diversify out of that one because they have a huge tax gain. But you still see that long-term approach to public investing? And
I do. We do see that. I think that, the way, even if you just consider passive investing, because most passive indices are cap weighted, you get what's called that power distribution. You get the highest returning assets, highest returning companies becoming a greater and greater share of the portfolio. And so that that creates for long-term holders issues on their own, where the most successful companies are the ones with the biggest allocation in the portfolio and the lowest cost basis. And so it's a continual challenge. And the way we approach public market investing is really twofold. One, a passive bias, a passive orientation, but also a tax efficient allocation. We are big proponents of aggressive tax loss harvesting, and it's not just looking for losses, through your portfolio and trying to execute them. It's actually more sophisticated than that, where we can generate with a portfolio what we call up to 2% tax alpha per year. And so if you can get an index type return and then get tax losses that you can shield tax payments to the tune of about 2% of the portfolio, then on an after-tax basis, you're much better off. So that's our approach. And I would recommend long-term investing in public markets.
Okay, well, Jack, thank you very much for your time and sharing some of your wisdom here today. And to all of our listeners, thank you very much for listening to Advisor Confidential, where we expose the rapidly evolving world that registered investment advisors are dealing with on a daily basis. And also, we'd like to thank our sponsor, Bailey Gifford, for helping us put this podcast together and sponsoring it. Anyway, please get in touch with us at Financial Advisor Magazine to learn more about expert wealth management growth advice by visiting fa-mag.com. And don't forget to subscribe and click the follow button to never miss an episode. We look forward to welcoming you back for the next episode of Advisor Confidential, the podcast series. Have a great day.
What is actual investing? We believe that it's a real-world task to deliver thoughtful capital deployment. It's not about speculating over the short term. It's about understanding the long-term opportunities for companies through technological progress or new business models. So we seek out those exploring big, new ideas that will change the world. Then we back them to give those ideas time to flourish. Bailey Gifford, Actual Investors. Find out more at baileygifford.com.
Thank you for listening to Advisor Confidential, the podcast series, where we dive deep into the evolving world of registered investment advisors. From compliance to client experience, digital tools to succession planning, we cover what matters most to RIAs today. Learn more by subscribing to this podcast or visiting fa-mag.com.